Much has happened since last week. Since then, our technical case has certainly not weakened. Bitcoin is as overstretched as ever. We are now likely in for a bullish reversal, and the specific reasons for that are precisely what we'll discuss in today's episode. But first and foremost, you got it, not financial advice. I'm a lunatic on the loose, do not listen to me. Yet, if you're a lunatic too, and if you happen to appreciate what I'm about to share with you, then please return the favor by smashing the like and subscribe button, so that you'll never miss out on any updates again. And to any Swedish-speaking followers out there, if you want to follow my Bitcoin and crypto analysis and signals in full, then please join us on AUGERE. We have now introduced more membership categories in order to fit every need. And we've also made the prices even more accessible to everyone out there. That's fancy talk for cheaper. Now on to Bitcoin. 3 things have emerged that truly deserve some individual attention. Let's now take a look at how and why Bitcoin is technically more ready to reverse than ever. The first thing that I want to bring to our attention is how the price volumes have begun to finally pick up. For if we compare this to any of the previous little dumps here, then this little cluster is more extensive than any other thus far. Now, with the exception of this Lone Ranger of a candle in December, the last time we had any price action to speak of was amidst the spring plunge of last year. The difference between then and now is that back then those volumes followed after a minus 50% plunge after only 9 trading days. This time around, however, the price has dropped by just as much, but in a slow 2.5-month dripping fashion as opposed to a crash. And this alone explains the rather humble capitulation volumes as of recently. Regardless of what, this volume cluster is the most extensive one since last year's spring cleaning. And the fact that it's dropped by as much makes it relevant to bring up, as it shows clear buying pressure at those low levels. Exhaustion volumes, if you may. Naturally though, this doesn't preclude further downside, yet it is a statistical clue of a strong barrier. Bollinger, an indicator we speak not much of on this channel. We have brought them up on previous occasions, though mainly in individual stocks. Now is certainly the time to bring this old tool out of the box, however. So why then are these bands relevant at all? How do you even use them properly? Stay tuned and you're in for a technical treat. Now, whenever the price closes outside of these bands, it indicates a highly strong price action, that whatever has happened has been an overreaction. These in turn either result in a reversal or else they result in a consolidation. Wow, that'll certainly help. Either the price does this or the price does that. Thanks a lot. How the hell then do we know which of the two is the likely way to go? Thank you for asking. The answer is rather simple, so listen carefully. Whenever the price closes outside of steep angle bands, it almost always means we're in for a correction, either in the shape of sideways movements or a formation, or else as a simple temporary price correction prior to continuing higher. Naturally, none of this is idiot-proof, that's just not how TA works, yet it's more than reliable enough to base decisions on. So have a look at some random charts and see for yourself. And this in turn leaves us with the second alternative. Any strong-witted viewers out there, which ought to be the most of you, as I pride myself in having the most intelligent follower base on YouTube, should have figured it out already. The second alternative is when the price closes outside a flat or somewhat horizontal band. This, on the contrary, speaks volumes for a reversal. Now, before commencing any further, do note that only actual closings matter when it comes to Bollinger Bands, and even more so, obvious ones. In this sense, if they're not visually obvious and you have to look for them with a magnifying glass, they just aren't strong enough, or rarely so at least. Now, if we take a good look at this chart, we can quickly identify several cases. The first one was in January last year, at which we saw 4 and 3 closing days respectively outside of the bands. And needless to say, those bands were steeply angled and thus resulted in temporary corrections prior to continuing its course to the upside. And the same principle also applied in February last year, and then we reached this plateau. And this is where things get interesting, as Bitcoin closed above these flat and non-champagne bands in both March and April last year. And the rest, as we all know, was the beginning of a serious plunge. Now, amidst this crash, we saw a close below these Bollinger Bands, at which the Bollinger Bands possessed particularly steep characteristics. And hence this here was, surprise surprise, the beginning of some extensive sideways movements. A range, albeit an aggressive one, and at the very end of this rocky road came another close below the Bollinger Band. At the very bottom, a fake out shakeout if you may, to scare away the weak hands prior to rushing towards the skies. And during this 130% recovery, we were warned of an overextended move at the beginning of September for a sell signal. And equally so were we kindly notified to get back into the game again upon the late September closing right here. And then finally we were once more told to get the hell out of the way upon the absolute all-time high in early November, after which the price has now once again had 3 consecutive closes outside those notorious bands. And this here, in combination with the significantly increased price volumes, tells us that we've likely established a bottom, but that we're not quite ready to proceed immediately to the upside. And the reason why this is not an immediate reversal is because of the steep angle of the bands. In that sense, we're likely in for some choppy sideways moves prior to being ready to take off to the north. And this can further be confirmed by the RSI on the daily chart, which all the way back since $57,000 has struggled to break above the neutral green 50 line, which confirms how and why Bitcoin has dropped by so much and so effortlessly. Hence this ambivalent RSI without any foothold to spring upwards, in combination with the ever so weak bearish blue channel on the 4-hour chart, tells us in turn that we're likely in for a couple of weeks or so, give or take of course, of range-bound moves before finding foothold, ideally on the lower bullish red, both on the 4-hour and the daily chart, before being ready to take off to the upside. And thus this right here marking the power shift from the bears to the bulls. By this token, do not be surprised if Bitcoin were to make another scaremongering move like this to severely damage and disturb any scared money, or bored money too for that matter, and simultaneously trick short bears into oblivion prior to swiftly turning to the upside in an aggressive move, to put it mildly. And such aggressive price pump can also be fully justified by this diagonal resistance line in the RSI on the daily chart. And once we break this, it will in turn infuse some extra oomph into the upwards cannonball momentum, again statistically speaking. And to further add on to this case, we simultaneously have an identical RSI setup in Marathon 2. Now, these closings in combination with the significantly increased price volumes give us strong cause to believe the bottom is in for now. But what then is our third and final reason? No, I'm not drunk yet, just trying to amuse myself with some lame wordplay. The other day I had a good chat with Alex, one of the owners of AUGERE. We often discuss cases at which we join our respective technical forces and strengths together. His being Elliott wave theory and mine being the RSI and overall similar stuff that you see on this channel. Alex had done an extensive Elliott wave count on Bitcoin and presented a case that hadn't even crossed my mind, but which, once I saw it, made perfect and immediate sense. To those of you who may remember, last year we talked about a possible zigzag. Now this in turn was counterfeit as the B wave took out the start of the A wave. And sure, you could force this here into being some sort of a flat, but on the other hand, it's certainly not without being stilted and by severely bending the rules. Then came Alex, who said that based on the technical structure thus far, this here is in fact a likely ABCDE triangle. And this makes all the more sense on so many levels. First and foremost, this here would drag out the pain and tedious waiting even more before being ready for that final pump to the upside. And secondly, as several sectors seem to have topped out technically, small cap stocks being really bad off already with price declines in the -50 to 90% since the spring-summer peak last year, and whilst the big rings to rule them all, as in big tech, primarily the FANGs, still seem to have more to give on the upside and therefore also push the S&P and US Nasdaq indices a bit up as well, in combination with some seriously depressed market sentiments, we should be in for some choppy and volatile overall sideways moves for a good few months to follow. And this would go hand in hand with the completion of a D and E wave in Bitcoin too, as Bitcoin by no means is immune to whatever happens on the main markets. And such turn of events, should it come through, should leave us ready to launch sometime in late spring or summer this year. And given that this here is the primary fourth wave of the secular fifth wave, as in the fourth wave of the fifth, we could and should be in for a serious parabolic move prior to closing shop for this time around. But take a good look at this 1 year long fourth wave correction thus far. The longer a sideways range formation or consolidation, the more gunpowder it's storing up for the upcoming move. Tesla, with its 6 years of sideways movements prior to shooting up by 3000% in the upcoming 2 years, is a great example of such. Now we should be in for something similar in Bitcoin and altcoins too. By such token, it would be fair to expect a final fifth wave secular target in the $125,000 to $185,000 range, just as we discussed in full already 2 years back. But neither would I be surprised if Bitcoin were to demolish those sensible targets, as the fifth wave of a secular fifth could very well prove to be nothing of the kind, as insensible. Metaphorically speaking, we could very well be talking those 5 tequila shots prior to the bar's closing. It'll sure be a fun way to top off a seemingly never-ending party night, but the hangover that awaits tomorrow will be nothing short of biblical proportions. Having said that, based on this extensive fourth wave primary correction, do not be shocked if Bitcoin were to vastly outperform any previous targets we've communicated so far. If things were to go real haywire, we could see something similar to that of 2017 and end up in the $300,000 to $400,000 range.